While the average retail investor panics and sells into a crypto market downturn, often locking in significant losses, the smart money, the institutional players, are quietly executing a profoundly different strategy: strategic accumulation. It's a pattern we observe time and again, a masterclass in exploiting fear and uncertainty to their advantage, and it's precisely why wealth disparities in this nascent asset class continue to widen. This isn't about luck or speculation. It's about a disciplined, data-driven approach backed by extensive research and significant capital that most retail participants simply fail to grasp or execute effectively. When Bitcoin plummeted from nearly $69,000 in November 2021 to lows of $15,500 by late 2022, or from its then peak of $20,000 down to around $3,000 in late 2018, the headlines screamed, "Crypto is dead." Major news outlets like the Wall Street Journal published articles questioning Bitcoin's very survival, while prominent financial commentators declared it a failed experiment. The Crypto Fear and Greed Index plummeted into extreme fear, often registering single digits, scores like 8 or 9 out of 100, signaling maximum market distress. Trading volume dried up, and market sentiment was unequivocally bearish, with many retail investors selling off their holdings at multi-year lows, driven by desperation and the pervasive narrative of collapse. This environment, perceived as catastrophic by the general public and a signal to exit, is in fact precisely what institutional investors look for. They don't buy the euphoria of the bull run. They meticulously plan and execute their purchases during the deep capitulation phases. Let's delve into the verifiable data that informs this strategy. Historically, Bitcoin's price has consistently bottomed out when its Relative Strength Index, or RSI, on the weekly chart drops below 30, signaling deeply oversold conditions. In the brutal bear market of 2018, this happened precisely as Bitcoin reached its $3,100 trough, a moment of profound despair for many. Fast forward to the 2022 cycle, and we saw strikingly similar RSI readings in the low 20s as Bitcoin touched $15,500, as meticulously verified by CoinGecko and other leading data providers. These are not random occurrences. These are the precise moments when on-chain data often reveals significant accumulation by long-term holders and institutional entities. Metrics like whale accumulation addresses, wallets holding substantial amounts of crypto, show spikes in activity, while exchange outflows increase, indicating assets are being moved off exchanges into cold storage for long-term holding. For instance, data analysis firm Glassnode reported significant long-term holder accumulation during the Q4 2022 dip. While institutions like MicroStrategy were making headlines for their continued Bitcoin purchases, quietly, other major players like hedge funds, sovereign wealth funds, and even public companies were strategically adding to their portfolios, understanding the intrinsic value. They are buying when the retail sector, often having invested at market peaks driven by FOMO and sometimes even leverage, is selling at a substantial loss, driven by panic and exhaustion, liquidating portfolios that have often depreciated by 80% or more. This isn't random speculation. It's a calculated entry based on robust technical indicators, historical patterns, and a profound understanding of Bitcoin's 4-year halving cycles, which consistently precede explosive bull runs. Institutions play the long game, demonstrating immense patience and strategic foresight, accumulating during the long, arduous crypto winters, positioning themselves meticulously for the subsequent springtime and summer. The implications of this sophisticated contrarian accumulation strategy are profound and far-reaching. By consistently buying during periods of extreme fear and intense selling pressure, institutions secure a significantly lower average entry price. For example, an institution accumulating Bitcoin around the $15,000 to $20,000 range in 2022, when retail was capitulating, stands to realize vastly superior returns compared to someone who bought at the 2021 peak of $69,000. This naturally amplifies their returns when market sentiment eventually shifts and prices recover, often dramatically. The wealth generated from these predictable cycles is then largely concentrated among those who had the substantial capital, the unwavering conviction, and the sophisticated analytical framework to act contrarian to the prevailing retail narrative. Retail investors, often entering at the peak of bull markets, lured by the promise of quick riches, or selling at the very bottom out of desperation to cut their losses, are effectively transferring their hard-earned wealth to these strategic, patient players. This dynamic contributes significantly to the escalating wealth gap, as the average person, lacking the institutional resources, time, and psychological fortitude, misses out on the very opportunity that institutions are designed to capitalize on. A recent report by Chainalysis indicated that a small percentage of whales, typically institutional or early investors, control a disproportionately large share of Bitcoin, underscoring this concentration of wealth. It's a continuous, self-reinforcing cycle, repeating with each market downturn and subsequent recovery, creating a stark divide between informed accumulation and emotional liquidation. Understanding this fundamental discrepancy in investment strategy and market behavior is absolutely critical for anyone hoping to navigate the volatile landscape of digital assets successfully. It's about moving beyond emotion, FOMO, and FUD, and embracing a data-driven approach to identify genuine value entry points with confidence. To help you dissect these complex market signals and make more informed, strategic decisions, we've developed the AI Signal. It's a free, daily trading signals newsletter providing exact entry points, critical RSI levels, and key support zones that often coincide with institutional accumulation, bringing institutional-grade analysis directly to your inbox. Stop buying the hype and start buying the dip with conviction, armed with the data you need to succeed. You can find the link to subscribe in the description below.